Okay, folks. I'm going to start today's class. I'm going to start today's class with two questions that you're going to hear probably for the next 2 weeks and perhaps even into 3 weeks. So here are the two questions. First, is there anybody in the class who's not part of a group yet? You keep your hands up and look around because you have a group right there, right? So one of the things to think about is maybe get together after class and see if you can create a group. You might be incompatible, in which case that's fine. But if you're not in a group, you need to get in a group soon. The orphan list is up there, and if you've been adopted, remove your name from the list. Don't leave it on the list. Second, and this is a question to everybody. How many of you have not picked a company for your project yet? Be open and honest. It's the second week. I understand fully. So really, that many of you have picked a company already? I don't believe you, but no, we'll let it ride. But I will keep asking that question, and hopefully by the time we get to the next week, there will be no hands that go up and you actually mean it. You actually have a company to analyze. There's a master list I've created. And I think people are terrified of actually putting a company name down. I'm not going to bind you to the name of the company you put down in the list. You can go in and change the company name. This is just for me to get a sense that everybody is on board. And as you go through the project, you notice there are additional columns that fill in. By May 8th, every single cell in that master list is going to get filled out because you're going to do the project, you're going to get the numbers. But the first step, of course, is picking a company. So I don't mean to nag you. Actually, I do, but I have to say that because it's not, you're not supposed to nag, but I will nag. No, but please get in a group and pick a company as soon as you can. So today's key word for the entire session is power. And let me explain. You know the old saying, power abhors a vacuum? In every company, there is power, and the question is, who has the power? If you as the shareholders don't have the power, is it the managers? If it's the managers who don't have the power, it's inside shareholders. So today we're going to delve deeper into who is behind the company, who's running the company, where does the power come from? And we know all of the traditional corporate charter stuff, and you're supposed to be responsive to shareholders, but the reality is power in a company can rest with people who don't own shares in the company. They could be lenders, it could be a government, even if it owns only one share. And that's part of what we want to talk about today. So the reason I keep pushing you to pick a company is, first step in understanding a company is to look at the company and say, where in this company does the power rest? Or how much power do I as a shareholder in this company have to create change? And the institution that you should probably look at first is the board of directors. In theory, they're there to protect you as shareholders. But in practice, the question you got to ask is, are they working for me? Are they working for the management? Now, of course, we've become very good at creating at least the surface level look of independent boards, right? Especially since Sarbanes-Oxley in the US and increasingly around the world, we've talked about how to create independent boards. So when you look at your board of directors, you're going to see a checklist. They look, independent. They meet all the criteria, and do all of that checking. In fact, there are now corporate governance scores that you can get for your company. I don't believe those scores very much, because all the scores tell you is that the company is very good at playing the checkbox game, which is when whatever the scoring company is sends out the list, they go check, 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 high score. The only way to see if your board is effective is through their actions. What kind of actions? If you can find any kind of news story or evidence that your company's board of directors has actually stopped the CEO from doing something, an acquisition, a decision to enter the streaming business or leave the streaming business, that is evidence that your board is actually acting with interests that might go beyond the CEO. So you're looking for actions. I'm not saying it's going to be easy to find. So look at the surface level stuff on your board. Is it independent? But also look at, is there any evidence that this is a company where the board of directors acts in a way that's independent of the CEO? So with that lead in, let's talk about what happens when shareholders don't have power. I'm going to make a statement up front, and you're going to find this out as you start delving into companies. In most companies, shareholders have very little power. And that's true even in systems like the US, where you think about shareholders having significant power. There are some companies where shareholders rise, they find a way to get more power. But in most companies, the power rests with the managers. And if the power rests with the managers and they're not afraid of what shareholders can do to them, if their interests conflict with what's good for shareholders, they're going to put their interests first. It's human nature. It's not because they're bad people, but if you have interests and another party has interests and you're making decisions, you make decisions that promote your interests. And in companies, this plays out in multiple ways. I'll give you a few examples of managers making decisions that are in their best interests. They will, of course, dress it up as we're doing this for the shareholders. And I'll start with something called greenmail. For those of you who never heard of greenmail, it's just like blackmail, but it's a lot more money and it's legal. So I'll give you an example of how greenmail would work. Early 80s, oil companies were being targeted by activist investors because it accumulated huge amounts of cash coming out of the 70s as oil prices went up. And as oil prices went down, the cash was just sitting on the balance sheets, and these companies were doing some stupid things with the cash. A company called Unical, Union Oil of California. Early 80s gets targeted by a man called T. Boone Pickens. Activist investors will get their profile out because that's part of the game. So I want you to play the role of managers at Union Oil of California. You've had a good life for a decade. Every morning, what do? You probably come into work at 10. What are you going to do? The oil price goes up anyway, so it's not like you're going to have to do anything for the earnings to go up. So you're sitting in your Brentwood house, drinking your coffee. Union Oil of California is a Southern California-based company. You're taking your time. What's the hurry? You open up the Wall Street Journal and you spit out your coffee. It says T. Boone Pickens targets Unical in a hostile acquisition. Words have consequences, right? When you see the word hostile, what does it tell you about what Boone Pickens thinks about you as a manager? Not much. In fact, he's very clear that this is a badly run company. He's going to come in and institute change. So you throw your coffee cup into the trash can, you drive as quickly as you can. In LA, that's quickly as you can. Who knows what the freeways are like. You finally get into the offices, an executive meeting has been called and it's 100% attendance. And the managers are together and you say, you know what? Boone Pickens has offered 20% over the current stock price. And your CEO opens his corporate finance text and he said, our job is to maximize shareholder wealth. And it looks like this is a good deal for shareholders. So that's one point of view. Just do the right thing, sell the, essentially try to negotiate the best deal. But there's a consequence here that's personal, right? If he becomes the new owner of Unocal, you will lose your job. So let me ask you a question. Given a choice between maximizing shareholder wealth and preserving your job, which one do you think might win out? This is, again, don't think of this as signs that people are not good. I mean, this is, if you were in that position, be honest. You're going to say, look, I want to save my job. And somebody comes up with an absolutely brilliant idea. He's saying, why did Boone Pickens have to make this announcement? It's because there's an SEC requirement that when you get to 5% of the outstanding shares in a company, you've accumulated that, you got to go public with what your intentions are. You can say, look, I'll continue to hold the 5% as a shareholder, or I want to do an acquisition. That's why he's announced that he's going to do the hostile acquisition. So here's the idea you come up with. Let's go to Boone and offer him a deal. Well, we will buy back his 5% at twice what he paid for the shares. And in return for getting the money, he has to sign what's called a standstill agreement, which basically says he will not try to accumulate more shares, because you know what will happen, right? If it's like a traditional blackmail, you pay the money, blackmailed again. This way you get legal cover, you're not going to get acquired. That's greenmail. You're essentially paying a hostile acquirer to go away. And you can dress this up as much as you want, but whose interests are being served by doing this? I mean, how do you get in front of your shareholders and say, I did this all for you. I wanted to make sure you did not get a price 20% higher than the current stock price. And you're saying, what? You did what? The reality is there's only one interest being served. It's managerial interest. I'm not saying it's not understandable. I can understand what, but that's greenmail. Clearly managerial interest being put over shareholder interest. Let's take a second example. Say you're a manager of a company, it looks like you can't stop the acquisition. You know you're going to lose your jobs. So everyone, it's just the top managers. So you go below that to middle managers, you don't get this luxury. So the top managers each go to their lawyers and they rewrite, keyword is rewrite their compensation agreements, where they put in a clause that says, if we're acquired in a hostile acquisition, we'll get paid 15 million, 20 million, 25 million. That's called a golden parachute. Everybody else gets lead parachutes. And trust me, with parachutes, you want neither golden nor lead, because neither, I think, will keep you up in the air. But that's a different problem. But golden parachutes effectively allow managers to cash out in an acquisition. You say, why should I as a shareholder care? Well, when you put in clauses, in the case of Revlon, they put in clauses worth several hundred million into their contracts. Guess where that money comes from? It comes from money that could have paid to you in the hostile acquisition. The acquirer takes that money out of your hands as a shareholder and sets it aside for the golden parachutes. Again, clearly managerial interest being served. Then you have poison pills. I have to tell you this about M&A. There's this weird mix of medieval times and James Bond movies in terminology. There are white knights and poison pills, and you're saying, get your history right. At least put yourself at the right time. Saying, what's a poison pill? You're the target company. You've been targeting an acquisition. You don't want to get acquired. In a poison pill, you go and put something in your company that makes you so unpalatable to the acquirer that they have to walk away. 30 years ago, the FCC had this very strict requirement on how many TV stations a company could own in a particular geographical area to prevent antitrust, keep competition going. I remember about 20, 25 years ago, entertainment companies would be targeting an acquisition. And the first thing they would do is they'd go buy a TV station in a city where the acquiring company had a TV station that was lucrative. Then they'd go to the FCC and say, you can't allow this to happen. It breaks the law. But poison pills can take lots of different forms. In fact, this was carried to an art form by law firms that basically made this their business, where they would go into target companies and they would help them devise ways of keeping acquisitions from happening. There's a man called Marty Lipton, legendary lawyer. If you get a chance, type in his name. And essentially his job was to make sure hostile acquisitions did not happen. And so I'll give you a simple example of a poison pill. You know how a rights plan works in a company? If you're a publicly traded company, does anybody know what a rights plan is? In a rights plan, what does a company do? It's not common in the US, but it's much more common in Europe and other parts of the world. So let's say you're all shareholders of a company. Stock is trading at $10. I want to raise fresh equity. Why? Because I want to take new projects. I want to build a new airport, whatever. Now I could issue shares at the prevailing market price, right? But then I have to hire an investment bank. I have to because you worry about the price dropping. You got to get investment banking guarantees as a transactions cost. Issuing new equity is expensive. We're going to talk about the issuance costs. So here's what I do instead. I give each of you the right to buy an additional share in the company. Remember, it's trading at 10, an additional share in the company at $5 per share. What does this accomplish? Well, you have a right to buy the shares at $5 at a discount. You think that'll hurt me? Not really, because after you've used the right, you'll have 2 shares, essentially at $7.50 or whatever it works out to. I'm not diluting you because when everybody gets shares, nobody's being diluted. It's like in a 2-for-1 stock split. Nobody's really hurt by it because everybody gets twice as many shares. So in a rights issue, everybody either exercises the right or they can sell the right back to the company. And the company can then raise the money anyway. So rights issues are very common in Europe as a way of raising equity without having to, because you don't need an investment bank, you don't need any guarantees. It's pretty much a given. The rights issue is going to bring in money. But here's what I'm going to do with the rights issue. I'm going to change the terms in the rights issue. So remember, you own shares at $10 per share. I'm going to give you the right to buy an additional share at $100 per share. You say, why would I use that right? As long as I run the company, it's $100. But if there's a hostile acquisition, the price drops from $100 to $1. So as long as I run the company, the rights issue is kind of worthless. But if somebody tries to do a hostile acquisition and succeeds, the minute after they succeed, guess what happens? All those rights plans start to implode. They become real shares. So when an acquirer acquires a company, he has to factor in that once he gets to 51% and thinks he's won the battle, all of a sudden there'll be twice as many shares because all those rights will get exercised. It's called a flip over rights plan. Clever, right? But it's designed to keep acquisitions from happening. And we can talk about good and bad reasons for it. But in this case, you're doing it to protect managers who do not want a hostile acquisition to go through. I'll give you the analogy that I think best explains a poison pill because it can be very complex sometimes. I have 4 kids. They're all grown up now. But I remember when I had only 3 and I took them out to breakfast one morning, brunch. So my 2 sons are older and my daughter was the youngest at that time, come with me. We sit in a booth. I sit on one side, the other 3 sit on the other because they don't want to sit with dad. My daughter is sitting in the middle, her 2 brothers are on either side of her. They all order eggs with fries. So the waitress comes in and puts the plates in front of them. The minute the plate lands in front of my daughter, she spits all over her fries. Disgusting, right? You know what she was doing? She was introducing a poison pill. Why is it a poison pill? You spit on your fries, you're not bothered, it's your own spit. You know exactly what happens if you're the youngest sibling and you have 2 older siblings and you have fries on your plate, right? You can look at the fries, but somebody else is going to eat the fries. She was introducing this preemptive strike of don't even think about it. So the next time you hear the word poison pills, here's what's happening. Managers are spitting on the fries, but they didn't even pay for the fries. You and I, as shareholders, paid for the fries. They're making sure nobody will get the fries. But again, It's not about the poison pill, but about whose interests are being served. Now, the reason I put those three up on top is the first three do not require shareholder approval. So basically, the board can do it on the part of management. They could put in these. The last two require you and I, shareholders, to actually be party to this process. One is with what I call shock repellent. Shock repellents, I told you that the language of M&A is full of this strange mix. Shock repellents are clauses you put in the corporate charter to make it more difficult for somebody to take you over. I'll give you one example. Normally, when somebody gets to 51% of the shares of the company, they get effective control of the company. What if I raise that to 66%? You're saying that's not fair. This has nothing to do with fairness. You can go into the corporate charter and change the threshold that somebody needs to get control of the firm to 67%. Here's a second example. Normally, when you get to 51%, you try to replace the entire board of directors of the company because you want a board that serves you. What if I created boards where the terms are staggered? It's like the Senate. You can get rid of only 1/3 of the board. It means it takes you 3 times as much time to get control of the board. Those are shock repellents, and shareholders are asked to vote for them. You're saying, why would I vote for something like that? Because managers convince you that they're going to use this to serve you. They say, if you give us these shock repellents, we're going to negotiate to get a higher price for you in an acquisition. Trust us. And there's a final example, and this is the most common of the 5, where managerial interests dominate shareholder interests. And this is perhaps the biggest of the 5. When you see an acquisition of a public company acquiring another public company, it could be Disney acquiring Fox, it could be, Microsoft acquiring, Activision. I want you to think like the managers of the acquiring company as opposed to the shareholders of the acquiring company. Remember, managers are spending other people's money on this acquisition. You're saying, but they have our best interests at heart. If you truly believe that, you are being extremely naive. Because they have their own interests. Like what? It could be ego, which is, I want to be the CEO of the biggest company in the world. Charles Bludehorn, who was CEO of Gulf and Western in the 70s. Gulf and Western was one of the original conglomerates. He did an acquisition of the month club. Every month they'd go acquire another company. He was very open about the fact that the end game that he was looking for is to make Gulf and Western the biggest company in the world. Not the most valuable, not the most profitable, but the biggest company. So when you look at an acquisition, sometimes you get caught up in the numbers and you're trying to make sense of it, but step back because there might be a much simpler reason the acquisition is going through because it serves some other interest that managers have, which comes ahead of shareholder interest. If you take during the course of this class, there will be some big merger that floats up into the news stories. Listen to what managers say about a merger, right? Acquiring company, target company, they will all claim that this is the greatest deal ever. And they will have an ecosystem that backs them up, right? There'll be bankers, there'll be consultants, and even equity research analysts who will kind of feed in, this is amazing, and they'll use synergy and strategic considerations and all the rest of the stuff to kind of push it through. If you listen to managers, here's what they will say. We know more about this deal than you do. Trust us. But when companies announce acquisitions, there's also a market reaction that happens, right? So when Microsoft announced they would buy Activision, there was a stock price reaction in Microsoft. That's investors passing judgment on whether they think the deal will go through. So here's where we are. If you listen to managers, 100% of deals are great deals. But if you look at what happens to the acquiring company stock price, the target company stock price obviously will shoot through the roof. But look at the acquiring company stock price. Then about half of all acquisitions, the acquiring company stock price drops on the announcement of an acquisition. So what's the market saying? Hey, we think this deal might not work in terms of creating value for us. Now, if I just stop and ask you, who knows more about the deal, managers or the shareholders are making judgment? It's a no-brainer. Of course, managers know more about the deal. But here's why you might want to listen to the market. If you track these deals through and you look at what happens to the acquiring company after deal, and McKinsey's done this study multiple times over the last 25 years, there is little or no evidence that synergy, the synergy to talk about, actually shows up. In fact, the profitability of the combined firm actually decreases relative to what it was before the merger. If you track acquisitions 5 years, 5 or 10 years after the deal, half of all acquisitions get reversed within a decade of doing the deal. I do a session in my valuation class called Acquirers Anonymous, 7 Steps to Sobriety. I know there's supposed to be 12, but they can never get to 12. And the reason I do that is I think acquisitions are an addiction. Once companies start to grow through acquisitions, they cannot go back to pick, because growing with projects is so much work, right? One project at a time, hundreds of projects. You do one big acquisition, it looks like you've jumped the queue, right? But if you look at acquisitions collectively, it's the most value destructive action of all the corporate actions you put together. You can wipe out 20 years of hard work with one bad acquisition. In fact, I'll give you an example to show you how an acquisition can not just destroy value in a moment, but destroy a company's credibility in the long term. You all heard of Eastman Kodak, right? All that's left of the company now is the name. But there was a time when this was the company that you thought about when you thought about cameras. So before the Japanese camera invasion, this was a company that basically dominated the camera market. In fact, it was considered to be, it was one of the nifty 50 stocks in the early 70s, where people bought in high growth, high P. Think of it as the equivalent of the high growth tech companies of today. People bought Eastman Kodak. Rochester-based, well-run company, good reputation. People had it in their portfolios because they thought this company has a niche, it's got a business model, it makes money. But its growth engine was slowing down. People were buying fewer cameras. The Japanese cameras were much cheaper and often much better. So you can almost see what's happening at Eastman Kodak. Managers are saying, what do we do? Our growth is dropping off. So they do what managers at companies always do when growth is dropping off. They call in a consultant. They say, McKinsey, come in and tell us, or BCG, come in and tell us. I'm going to bring BCG in. Now, BCG is famous for creating a matrix of growth and profitability. And they're all, it's like a farmyard. I mean, lots of animals wandering around, cash cows and pigs and dogs and, all kinds of things. And basically, they probably came into Eastman Kodak and said, you have a cash cow in your camera business. You need a star. And in the late 80s, guess where all the stars were? They were pharmaceutical companies. High pricing power, huge margins, growing fast. So you can almost see, the BCG saying, go buy a drug company. And Eastman Kodak listened. They decided to buy a company called Sterling Drugs. And they talked about synergy. I'm not sure how there is synergy between a camera. Maybe you figure out a way to deliver drugs through a camera lens or whatever it is. But clearly you can see it's almost like you have to talk about synergy. So let me finish, keep going with the story. Sterling Drugs was trading about $40 per share when Eastman Kodak decided to target them. And Eastman Kodak offers a premium, and then they get into a bidding war. Now, if acquisitions are value destructive to begin with, if you're acquiring a company in a bidding war, things got a lot worse. They get into a bidding war with a Swiss pharmaceutical company called Hoffmann La Roche. They keep bidding and bidding. Hoffmann La Roche drops out at $72 per share. But Eastman Kodak did not seem to notice that they dropped out. It's like being on eBay. And you keep bidding and bidding, and you're bidding against yourself, and you keep beating yourself and say, I'm really good, I'll keep bidding. And they win. They ended up at $89.50 per share. They won the bidding war. So the next day, if you looked at the Wall Street Journal, the headline would have been, Eastman Kodak wins bidding war. Maybe may you be blessed or cursed with victories like these. Because the day they won their bidding war, guess what happened to the Eastman Kodak stock price? It dropped by about $5.2 billion in one day. In one day, they probably wiped out 20 years of hard work in terms of picking projects. So what's the market saying? You overpaid by 5.2 billion. That's basically the only mechanism the market has, right? And you overpay for something, it has to take it out of your money. This isn't you can't magically create money out of nothing. Now, this might be pure coincidence, but it turns out that the premium they were paying was, I'm sorry, the decrease in market value was 2.2 billion. The premium they were paying was 2.1 billion. Does this look like a zero-sum game? If you take a company that's fairly priced, you pay a $2.1 billion premium, you're saying, what's the extra 100 million for? Investment banking fees, BCGs, consulting fees, whatever it is. No. It seems unfair. At that time, of course, Eastman Kodak's managers said, if you see what we see, all the banking projections on synergy, you wouldn't be doing this to us. But let's follow through on this merger. So merger happens, you track Eastman Kodak's earnings. At least in theory, if this is a good merger and there's all this benefits you're getting, what should happen? Your earnings should go up, right? Take a look at Eastman Kodak's earnings. Nothing's happening. You've spent $5.1 billion, and there's no effect essentially on your earnings. So if there's synergy, where is it showing up? And if you follow through, about 5 years later, rumors start going around that Eastman Kodak is thinking about selling its drug business. Remember, I told you your mistakes finally come out. You know, when it first come out, when the rumors first came out, Eastman Kodak said, no, the rumors are all false. Where, in fact, I'll use the words that Louis Mattei, chairman of Sterling Winthrop, which was the division of Eastman Kodak that did the drug, said, this is massive speculation which flies in the face of the stated intent of Kodak that it's committed to be in the drug business. Remember the famous words from the old US, never believe anything until it's officially denied. Because in this case, it turned out that a few months later, Eastman Kodak did sell off Sterling Winthrop for $1.7 billion. Remind me again how much they paid upfront? 5.1 billion, right? No, you don't need to do any IRR calculations. No, if you pay 5.1 billion in 88 and you get back 1.7 billion 5 years later, that this is a horrifically bad deal. An equity research analyst, and this guy, Samuel, I don't know the guy, said this announcement is very good for, but he said the same things 5 years earlier. It's almost like he was reading from a script, right? It's very good for it. The bottom line here is when you see acquisitions, it's easy to attach all these big financial considerations. It must be for this, but it could be very simply that managers really want to get this deal done or acquisition done, and they're intended doing it at any price. So here's the bottom line. If managers are not afraid of what shareholders will do to them, they will put their interests ahead of management. Once in a while, your interests might converge, but if they ever diverge, managerial interests are going to win out. So as I said, today's session is about power. Where does the power lie? And I want you to think like the shareholders, whichever company you decide to analyze, and ask, how much power in this company would I have as a shareholder? So I'll give you the choices. Maybe your company is one of those very unusual companies where outside shareholders actually have the power to change management. And so the utopian corporate finance world where managers are in fact accountable to shareholders. That's one choice. The second is this could be a company where there are shareholders, but there are two classes of shareholders. Inside shareholders are part of the management and outside shareholders who are not. For those of you who read my post on the Adani Group, you're a shareholder in the Adani Group, don't even operate under the delusion that what you think about what should happen is going to have, that's not going to be input into the process. Or a few months ago, I wrote about Facebook, and I'll come back and look at Facebook a little more closely. If you buy shares in Facebook, the inside shareholder, of course, is Mark Zuckerberg. He owns only 14% of the shares in terms of share count. But he's tilted the game in his favor by having voting and non-voting shares. I'm not saying it's good or bad, but you can have companies where inside shareholders call the shots and you on the outside just can look in and say, I wish you did that differently. I wish you didn't spend 100 billion in the metaverse without telling me what's in there. You could have companies where managers essentially run this. So these are not even inside shareholders. These are companies where managers have acquired enough power. There's not much pushback. And essentially, these are managerial companies run. I'm not saying they're badly run. They're run in the best interest of managers. So you can have outside shareholders, inside shareholders, managers. But let's finish it. There are some companies where lenders may effectively run the company, especially if a company gets into enough trouble that covenants kick in. It could be that the bank says 2 of the directors will be directors from the bank, and they're going to watch out for interest. So troubled companies can sometimes end up with lenders calling the shots on what you can invest in, how much to borrow, how much you can pay in dividends. There are companies in Europe especially where employees effectively have the control, either through ESOPs. ESOPs are, of course, employee stock option plans where they bought shares in the company, or because the law requires that the board of directors have 2 or 3 members from the union employees. You could have a company where employees call the shots. Again, I'm not saying it's good or bad, but it can happen. And finally, there are companies where the government is either an explicit shareholder and has a big role in how the companies run. Often companies that used to be government owned that are now publicly traded, or it could have implicit power through the fact that it has a golden share, a veto power over big decisions. See, how the heck am I going to know who in my company is calling the shots? One of the things I think it's useful to start your analysis with. So if you picked a company, try this out. This is a Bloomberg page listing out the top 17 shareholders in your company. You can get a similar page by looking at Yahoo Finance or Google Finance. It's public information. It lists out who the largest shareholders in your company are. You're saying, how's that going to help? Let me take you through my companies and see what I can learn about power in my companies by looking at who owns shares in my company. I'm going to start with Disney in 2003. I'll show you Disney in 2013 and perhaps even Disney in 2022, so you can see how it shifted. But Disney in 2003, I looked at the list of the top 17 shareholders and my stomach dropped. First, take a look at the third source. It says source 13F. That's a filing made by a mutual fund or an institutional investor with the SEC when they hold shares in a company. So 16 of the top 17 shareholders in Disney are mutual funds. Remember what I said last week about mutual funds? If they don't like the way a company is run, they're not going to stand and fight. So 16 of these 17 shareholders are either going to go along with managers or just going to vote with their feet. They're not going to fight my fight for me if I want Disney to be run differently. There is a 17th, which is Roy Disney. But first, he owns, if you look at the percentage of the shares he owns 0.66%. This is a classic, company in terms of dispersed shareholding. Nobody has enough incentive or power to push back, where managers are basically going to call the shots. And I would argue there are lots of publicly traded companies in the world, especially older companies, where this is the case. There are no big shareholders. Nobody has an incentive to push back. We might talk about when that might change, but 2003 Disney, my reaction is this is a company where managers are not going to listen to me. Let me move on. Second company is Vale. Remember I said Vale is a Brazilian mining company? We backfill some history. Vale used to be a government-owned company until about 30 years ago. Then they privatized it, they took it public, but they created 2 class of shares. I'll give you the names of these classes to show you how Orwellian the naming of shares can sometimes be. One class is called preferred shares, the other is called common shares. Now, if you buy shares in Vale, you buy the preferred shares. You think, I'm feeling special, I get the preferred shares. You know why you're preferred? Because you get no voting rights. I'll give you a little dividend each year to just go away. But preferred shares in Brazil have no voting rights. They're controlled by common shares. And the common shares are held by 6 or 7 entities, one of which is the Brazilian government's
own funds. So basically, this is a company where there are lots of shares that you and I can buy in the company, but we have absolutely no voting rights. But the common shares where you get to make the decisions are controlled by 7, 8 entities, many of which either are the government or have links to the government.
Let me even load up the dice even more here. The Brazilian government has a golden share in Vale, which means that if Vale wants to make a big decision, an acquisition, a new investment, the Brazilian government, if it chooses, can stop the company from doing it. So the common shareholders essentially are those who pick the board of directors. And you can already see that while the government, this is not a government-owned company anymore, it is a company that still is run by the government indirectly. You think, so what? Remember what we said about self-interest? If the government is the largest shareholder in your company or happens to be the power behind the throne, your decisions are going to reflect that, right? I'll give you one example. You're a traditional company and you're a multinational, and you think about how much taxes to pay. Do you want to pay the most taxes you can or the least taxes you can? Set aside your patriotic fervor for the moment. You're a business. You don't sit there saying, how do we pay the most taxes we can? So if you're a typical company, you're looking for legal ways. I'll fully cover myself here to pay as little in taxes as you legally can, right? So let's say you come up with this great tax plan at Vale, reduce taxes paid. You get in front of the board of directors and you say, you know what, we've come up with this plan where we can reduce our effective tax rate from 25% to 22%. And the two representatives of the Brazilian government put up their hands and say, we have some issues with that. You can see why, right? Where do the taxes go? They go to the government. You know the effective tax rates of government, I won't even say controlled companies, but companies with the effective tax rates of those companies are about 8 to 10% higher than the effective tax rate of other companies in the sector. And you're going to see this play out in decision after decision, right? Your investment decision. Do we build our next, do we put our next mining investment in Brazil or do we put it in Canada? The Brazilian government has a say that much rather you invest in Brazil because, so again, I'm not saying it's good or bad, but you can see how decisions are going to be altered by who's pulling the strings. Let's move on to Tata Motors. Of the top 17 shareholders. And if you look, there are about 1, 2, 3, 4, there are about 6 of the top 17 shareholders are the Tata companies. It's a cross-holding structure. This is not a conspiracy. It's a reflection of their history. Until about 30, 40 years ago, these companies were privately owned. And the way they got capital was often by, if Tata Steel had a good year, they would invest in Tata Motors. Nothing conspiratorial about that. That's how the families funded each other. And the accounting transaction would be Tata Steel invests in Tata Chemicals, they get shares in Tata Chemicals. So when you get old holding group companies, you're going to see this cross-holding structure. But you can see the corporate governance consequences, right? All of the Tata companies at one point in time at their headquarters in Mumbai House, one big building in Mumbai. So the first floor would be Tata Steel, second floor Tata Motors, and the very top of the building would be Ratan Tata, the patriarch of the family, controlling a group called the Tata Group, which basically owned nothing but is a holding company. Do you think there's any big decision that's made on any of those floors that first doesn't get bounced off the top floor? Again, it's not a conspiracy. It's a fact that if you have a family group running multiple companies, they have their own interests. And sometimes those interests might mean that Tata Steel shareholders will have to lose for Tata Motors shareholders to gain because the family overall feels that's a better solution for them. When you buy family group companies, you are effectively buying into the entire group. The control is going to drive the family. In this case, they can control these companies with well below 50%, 30%, 20% because of the cross-holding. In Southeast Asia, you have pyramid structures. The holding companies holding shares in 2 other holding companies hold shares in 4. It's like, you say, why would you do this? Because at the very bottom of the structure, the operating companies. And if you hold the top of the pyramid,
with 51% of the first two holding companies, you can effectively control work out the math, 0.51 times 0.51 times, you can effectively control what's at the bottom of the pyramid with 5% of the shares. Tata Motors, as we go through this class, you're going to notice them do things. And why would they do that? It doesn't make sense. But you're thinking from the perspective of the company. Step back and say, if I were the Tata family, does this make sense? Because remember, you control 25 companies. Your wealth is driven by all 25 companies. Which brings me to, and when I did this with the Tata Group, I did this in India about 10 years ago. The first response I got was, but this is a benevolent family. It's a family that has a great reputation, and it's true. The Tatas, in terms of family groups, have a history going back 100 years of essentially doing things right. And I said, you know what? It's got nothing to do with benevolence or good families. It's about conflicts of interest and how they play out. And if you get a chance, you might want to take a look at what's happened in the Tata Group over the last decade. You can see even in the very best of family groups, you're going to see these tensions boil up to the surface. Tata Motors right now is TCS, which is the bulk of the value of the group, plus all these other Tata companies that have a history in the group. It might have been around 30, 40, 100 years. TCS is the engine that drives the group. And in my view, and I'm going to try to provide evidence, the other companies live off TCS. They're able to do things because of the success of TCS, which if you're a TCS shareholder should make you a little pissed off because they borrow against your value. You lose that capacity on your own. But that's exactly what you should see in family group companies. The family group's interests are going to be put above the interests of any individual company. Which brings me to Baidu. I already described Baidu, right? It's a search engine which gets almost all of its revenues in China. It's a search engine which now has other businesses. So we can debate how great it is as a company, how well run it is. But here's the problem. When you buy shares in Baidu on the NASDAQ, you're not buying shares in the Chinese operating company. You're buying shares in a shell company in the Cayman Islands, which owns what? Absolutely nothing. Technically, your legal claim is to whatever cash flows come from the Cayman Islands shell entity, and the cash flows are zero. But what keeps the value afloat is the fact that the Cayman Island shell company has an operating agreement with the Chinese company where it can essentially, all the numbers are supposedly flowing into the shell company, supposedly. But it all rests on the legality of the structure. You're saying, why would Baidu go through these contortions? Why not just list in Hong Kong or in Shanghai? The answer is very simple. For the longest time, technology companies in China were viewed as being companies that should not be selling shares to outsiders because they're viewed as sensitive to the economy. So if you're Alibaba, or you could not, list shares in Shanghai, you could not list shares in Shanghai and have outside shareholders because it would be viewed as breaking the law. This effectively allows these companies to have their cake and eat it too. They could raise money on the NASDAQ, and if pushed, they can say, well, it's not for the parent company, it's for the shell company. So it maintains this illusion of, hey, we're not breaking the law, we're raising capital, and it's okay. Something to think about, right? Tomorrow, if the Chinese government says all these agreements are null and void, you'd be holding shares in Alibaba and Baidu, which are effectively worth nothing. In the last 3 years, one of the things that's happened to big Chinese tech companies is the Chinese government has gone from being an ally, which is what's the bulk of their lives, to essentially an adversary. Why? Because they were worried about control essentially slipping away to these companies, their big user bases. So if you look at the last 3 years, you're seeing many of these companies trying to get listed back in China, removing these shell entities. But something to factor in when you say, if I buy shares in Baidu, how much power do I have in the company? The answer is absolutely none. So let's move forward to 2009. 2003, remember Disney shareholders were widely dispersed, and I looked at that list and said, nobody on this list is going to watch out for me. This is 2009, Disney again. And there's one big change in the list, right? Who's on top of the list? A guy called Steve Jobs. How the heck did he become Disney's largest shareholder? I thought his fortunes were connected to Apple. What happened that made Steve Jobs the largest shareholder in Disney? Yeah. Go ahead. You had a hand up? Yeah. Exactly. He owned Pixar. And as you know, Disney bought Pixar. And when Disney bought Pixar, they paid in shares. And overnight, Steve Jobs became the largest shareholder. Now, I want you to think like a Disney shareholder. In 2003, you looked at that list and you said, I have no hope. You have a little more hope now? What do you want the board of directors to do? To essentially ask tough questions, right? You don't want go along and get along people on the board. You want people who push back. Now, there are lots of ways you can describe Steve Jobs, but go along and get along is not a set of words you would use. This is a guy, if he's sitting on the board and he thinks what Disney's doing is stupid, he's going to say, that's stupid. You're actually putting a keyboard on. Nothing with a keyboard ever works. You always need a screen that you can use. I mean, you know Steve Jobs' fixations. That's good. Because even by 2009, you could see that the entertainment business was changing. That the old model of make the movie, send it to the theaters, make money off it for 3 months, then put it on a DVD it was changing. And you wanted companies to wake up, and Disney was the most history and legacy about the companies. So I feel good about the fact that Steve Jobs on the list, not because he'll go along or because he's going to provide wise advice. Let me be very clear. It's because he's going to push back. Sometimes his pushback might be stupid, but it's good to have pushback. So that's the first leg. Stockholders as managers. So let's review. In theory, stockholders have all this power over managers through annual meetings, board of directors. In practice, those powers are much more limited, so managers put their interests over shareholder interests. First link starts to frame. Let's move to the second link. In theory, what happens? People lend money to a firm, and even if they don't protect themselves, they don't get ripped off. Why? I could tell you stories because companies care about reputation effects. They don't want to take advantage of lenders because then they can't go back and borrow more money. I can tell you all the stories I want, but the reality is if you lend money and you don't protect yourself, you are going to get ripped off. The question is when rather than whether. You say, but doesn't it matter who I lend the money to? What if I lend money to a really reputable company? It's been around a long time. I'll tell you a story. This for the story to work, you got to put yourself back in time and change your age. So it's early 1980s. You've just retired. You have $500,000 in savings, and you move to Florida. Why? Because everybody else is. And you live on a golf course. Why? Because you want to start playing golf. You're a retired person now, isn't what retired people do. So you have $500,000 in savings, and you say, what do I do with it? So as you're sitting at the bar of your golf club, I'm a broker. That's where I show up because I know there are a lot of old people's money, and I can provide advice. So I'd ask you. So I introduce myself to you. I'm a broker. I can help you. And you say, look, I have $500,000 I need to invest somewhere. They say, how about a mutual fund? You said, no, too risky. This is my retirement money. I want something safe. I said, how about a nice treasury bond, government bond, US government doesn't default. Initially, you're a little, you think that's a good place to go, but I tell you it's 5%. You say, that won't cover my golf fees. I need to make a little bit more. And I said, look, I have the perfect investment for you. Have you ever heard of this company called Nabiscoed? You say, yeah, I've seen them in the grocery store. They make all the stuff that I buy. It's been around 70 years. They've issued corporate bonds, and you can buy these bonds, and they're AA rated. You say, what the heck does that mean? And I tell you, no AA rated company has ever defaulted while it was rated AA. I'm a very careful broker, and that's technically true. So you put your money in Nabiscoed bonds, you're making a nice 6.5% or 7%. You go back to playing golf. 3 years later, you're sitting at the same bar, you open up the Wall Street Journal, and here's the headline. RJR acquired by KKR in an LBO. All these acronyms flying around. You have no idea what it means, But RJR was the first name of this Nabisco company. He used to call me, so what the heck happened? Technically nothing, don't freak out. But this outfit called KKR has come in from New York and they've done a leveraged buyout. That's what an LBO is. What does that mean? Well, they borrowed a lot of money and acquired Nabisco. So what does that mean for me? So technically you're still getting the same coupon that you were getting yesterday. But remember that AA that I talked about 4 years ago? You're still in the alphabet, but you kind of slid, you're BB. See, what does that still mean? Well, there's a much greater chance now that they will default. And remember the $500,000 you had yesterday? It's only 400,000 today. You see why? If you go from being a AA rated bond to a BB rated bond, and you have the same coupon, the only adjustment the market can make is to pay a lower price for the bond. You just got Nabiscoed. We're going to introduce that word into this class. Because whenever a company borrows money and the lenders don't protect themselves, they're going to get Nabiscoed. So those Adani lenders who are getting Nabiscoed today, why are you shedding tears about this? This is exactly what happens when you lend money and you don't protect yourself. So if you're thinking about, hey, if I lend money and I don't protect it, if it's a reputable company, nothing bad will happen, that's far from the truth. In fact, I'll show you the graph of what happened to Nabisco bonds on the day of the LBO. This is the story you don't read on LBO days, right? You look at the stock price, and what do you see in the stock price? It jumps 15% or 20%. Take a look at bonds of companies that go through leverage transactions, and you're going to see often the opposite reaction as to what you saw. Let me go back to the previous page because I want to talk about why lenders and equity investors are not on the same page. What do lenders care about? If you're a lender to a company, what do you care about? Am I going to get paid? Am my interest payments going to get paid? Do you care about growth? Only tangentially, right? You're not going to get any of the benefits of upside. It's about getting paid. So when you think about risk, you're saying no downside risk. So I want you to think about what would happen if companies were run by lenders. You have a risky project versus a safe project. Even if the risky project will add more value, you're going to pick the safe project over the risky project as a lender because you don't get in the upside. So the kinds of projects a company will pick will be different if lenders pick the projects rather than equity investors. If you're a lender to a company, when the company decides to grow and it wants to raise money, do you want them to raise money with more debt or use equity? What benefits you? Be completely selfish. You're a lender. You want to be protected. You don't want more debt because it means more people going after the same assets. You want companies to issue equity. Do you see where I'm going, right? Every decision, the investment decision, the financing decision, and the dividend decision. If you're a lender to a company, how much dividends do you want them to pay? None, right? Because you'd like the cash just sitting in the company. I'm not saying this is good or bad, but you can see already that what's in the best interest of lenders and what's in the best interest of equity investors will not converge. And if you're a lender, you've got to factor that in. You cannot assume that equity investors will make decisions in your best interest. Why would they? So whenever you see a bank lending on an LBO and then sitting back and acting like it's a regular loan, the question you have to ask is, do you want your head examined? Why would you do that? The KKRs and the BlackRocks that are doing the LBO have a very different set of interests than you do. At least have a say in the big decisions, because if you don't, we know exactly how this will play out. So lenders lend money to a firm and they don't protect themselves, they will get Nabiscoed. Let's move on to the last link. What do we assume companies do? That they're honest and timely in the way they reveal information, right? What universe is that going to even happen? And again, it's not because companies are bad, it's human nature. How many of you are married? Any? Okay. So let's say you have something bad happen during the course of the day. I'm not predicting anything bad happening, but let's say, you get home and your spouse walks in. You don't open the result. I have some really bad news. Let me share it with you, right? If you have really bad news, you do one of two things. One is you wait for a good time. Maybe after 3 glasses of wine, my spouse will have no idea what I'm saying. And that window of opportunity, but those open and close very quickly. The other is you wait till your spouse falls asleep, and then you tell them the bad news. So what I told you last night, I don't remember that. No, I definitely told you. Companies do something similar. This is not about breaking the law, committing fraud. They look for a good time to let out bad news. Now, window of opportunity close. So when is the market asleep? Well, maybe this is pure coincidence, but about 30 years ago, I used to do academic research. I don't waste my time on that anymore, which is you take a question that nobody wants to know the answer to, and then you spend 6 years of your life writing a paper on that question. Why? Because you want to get published and you want to get tenure. Thank God that's done for me. Okay? But this was about early 80s, young academic. I'm working on a paper. So I decide to look at a question. I mean, you have earnings and dividends announcements every day of the week coming from markets. Do they have different effects? Are Mondays different from Tuesdays? Tuesdays different from Wednesdays in terms of the content of the news? I'll cut to the chase. Monday, Tuesday, Wednesday, Thursday all looked about the same. And then you get to Fridays. Terrible things happen to companies on Fridays. Awful things. And then you take a closer look at Fridays, and it's not even during the course of the day. It's after 4 o'clock in the afternoon that horrible things happen to you. If you don't believe me, wait till the market closes this Friday and take a look at the news stories that come out. It's amazing how terrible things are at 4:01 and 4:00. But the reality is, bad things happen during the week. Why do you release it after 4 o'clock on Friday? Because of this misplaced belief that people will forget over the weekend that that rogue trader in London lost $8 billion of your money. What universe are they going to forget? So when they come in on Monday, guess what they do? They sell. Monday is the worst day of the week to invest in US equities. It's been true for the last 80 years. And maybe one reason for that is all the bad stuff that seems to happen over the weekend. So one of the tactics that companies do is they try to delay news till a good time. What's the other strategy you try as with your spouse? You try to bundle the bad news with some good news, right? It almost never works. I have some good news and some bad news. The bad news is I wrapped the car around a tree this morning while I was going to the train station. But the good news is I switched to Geico. Completely disproportionate, but you hope that it kind of weathers the blow, right? Have you noticed with companies, we lost $3 billion last year, but our operations in the Caribbean have doubled in revenue. So the fact that you made $1 last year and $2 now, that's a doubling, but you're hoping that it weathers the blow. Companies do this all the time as well. Earnings report come out, horrifically bad news. 2009, every bank would come out reporting billions of dollars in losses. But almost as an afterthought, they would say, we lost $3 billion, but we're not Lehman. I said, thank you. You haven't gone bankrupt yet. I should feel thankful about that. But you can see companies play the information game. And that basically means that the information that comes to markets is not always timely. And it doesn't get to investors. So investors have created their own mechanism, which is if you're supposed to report earnings on Wednesday and it doesn't come out on Wednesday, guess what you assume? Must be because it's bad news. The absence of news then gets, and who can blame investors? Because why are these guys not telling me this? Now, I'm not going to tell you that companies don't commit outright fraud. Of course, some of them do. I still think it's the exception rather than the rule. But some companies step over the line. I'll give you an example. Late 90s. There's a company whose business was lending to people with bad credit. It was a pretty good business. And so until one day you open up the Wall Street Journal, there's a story. Here's what the company says. We cannot find our CFO.
That's a good story. We've looked everywhere, under his desk, in his home. And by the way, half our cash balance also seems to have disappeared. I'll let you fill in the blanks. Oh, here's another example. In the early 1990s, a company called Briex, gold mining company, claims to have found, at that time, they claimed to have found the biggest gold reserve in the world, somewhere in Indonesia. And remember, in the 1990s, Indonesia was somewhere over there. And it was one of the most highly touted gold mining stocks on Wall Street. It's a Canadian gold mining company. In fact, they flew analysts out to where they claimed they found the gold, and they salted the earth with gold dust. Remember, most gold mining analysts on Wall Street have never been in a gold mine. They think gold comes in bars and coins, and they don't recognize the messy business. So they salted the earth. The analysts and said, look, there's so much gold under the ground, it's coming out. Or run back, right? Buy the stock, there's so much gold under the ground, it's coming out. Stock soars in value until one day in the mid-90s, 96 or 97, there's a story that the geologist, lead geologist of the company, who knows a big part of finding the gold mine, had jumped out of a plane at 32,000 feet without a parachute. Nothing good happens when you do this, and nothing good happened to this guy. But in the weeks after, the months after, people started, why would he do that? And in the months after, the company starts releasing things like, we told you there were 100,000 ounces. We'd take the last zero off. It's really 10,000, and then it became 1,000, then it became 100, and finally they admitted there was no gold. The whole thing was an elaborate fraud that they pulled off for a decade. That's clearly over the line. There are some companies that do commit outright fraud. But the bottom line is information can be delayed. It can be sometimes, fraud. And as a consequence, markets are a little edgy. Can we believe companies? Can we not believe them? And if you look at the other side of what we assume that, remember the trading room full of polite intellectuals that I talked about? Let's go back and get real. You ever been in a trading room and a news story hits? It's anything but polite or intellectual, right? Markets are not always rational and cool. In fact, they're the exact opposite, right? It's always hot, and strange things happen in the aftermath of information. I know in finance, we have this bad habit of assuming rational investors and rational behavior. And I have a very simple test whenever I get too carried away with the rationality argument. It's called the Elvis Presley test. It's a two-part test. Let me try the first part on you. How many of you think Elvis is still alive? That he lives in Michigan, he's grown a big beard, he's 110 years old, and he's still singing songs that nobody listens to. That's one story. He said, I read it in the National Enquirer last week. But the reality is he's been dead. He's been dead a long time. So he died in the late 70s, 1977, 70. Have you ever read USA Today? It's like a McDonald's version of a newspaper, right? If you are in a real hurry to read the news and you want to read it in 15 minutes, cover to cover, you can read it. But the USA Today, for the longest time, used to have a poll every day. Remember, it comes out every weekday. It's 250 polls. So they start run out of questions to ask. So they start asking questions like, do you like lettuce in your burger? 65% said yes, 29% said no, and 6% said, I don't know. Have you ever wondered about this? Every poll, there's this floating percentage of people who say, I don't know. Americans were asked, do you know your name? 93% said yes, 7%, I don't know. Deeply paranoid fringe that's convinced that any answer they give could be used against them. So this is, I think, in 1992, on the 15th anniversary of Elvis's death, they decided to ask this question. Do you think Elvis Presley is still alive? 72% of Americans, thank God for small blessings, said no, he's dead. 21% of Americans, 15 years after his death, said no, I know he's alive. There's a conspiracy. They keep telling me he's dead, but he's really alive. And of course, 7% said, I don't know. Let's set the 7% aside as paranoid and rational. Remember, the two words are not mutually exclusive. Maybe the rest of us
are the ones who are being irrational. But think of 21% of Americans 15 years after Elvis's death, thinking Elvis is still alive. So roughly 60 million people walking around thinking Elvis is still alive. The next time somebody tells you a company makes an earnings report, people gather together and make a rational, cool assessment, ask yourself, what are these 60 million people thinking Elvis is still alive doing? They're not projecting cash flows for the next 10 years. I think it'd be an interesting research exercise, if any of you want to do it, is to find these 60 million people and find what they have in their portfolios. It might resolve the entire question of why is Bitcoin trading at 23,000? There's 60 million people walking around thinking Elvis is still alive. Why won't you buy something which has supposed value, even though nobody uses it? Because it's scarce. What I'm trying to say is there are lots of irrational people out there. You know what market efficiency people assume, right? That they average out, that there are irrational people on both sides. But what if they get together in a crowd and all move in the same direction? That's when you get bubbles, is when you get people who basically are not, they're almost immune from any rational argument. Don't even try. It's a waste of your time. But what I'm trying to also say is when you look at corporate finance and you are making decisions and you say, if I do this, it's the right thing to do, will the market reward me? Be realistic, which is it might or it might not. Eventually you hope it will, but in the short term, who knows? So I'm going to ask you a question to which I'd like your gut feeling response. Embedded in a lot of the critiques you hear from ESG people, sustainability people, is the idea that you can't trust markets. And one of the reasons you can't trust markets, you probably read this often enough that's become almost conventional wisdom, is that markets are short term. I'm sure you've heard that, right? They react to that. They don't reward companies that make long-term decisions. So I'm not going to prejudge that question or pre-answer the question, but I'm going to take you through a series of questions. First is, focusing on market prices will lead companies towards short-term decisions over long-term value. True or false? As I said, make your pick right now. No, I want to ask for a show of hands. What does your gut tell you? I mean, because you've already come in with a lifetime, you've already lived, you read about things about markets, you've experienced markets. Focusing on markets will lead to short-term decisions. Second, if you don't trust markets to make those decisions, you got to trust somebody else, right? The decisions don't get made. So if you don't trust markets, managers are going to make the decision. So my second question is, if you allow managers to make those decisions, will you get better long-term decisions? Do managers think more long-term than markets do? And maybe the third point is neither managers nor markets can be trusted to make these decisions. Maybe you need a government or a regulatory agency making these decisions for you. In a sense, this page captures the question of what do we do about companies? Should we let companies be run to maximize stock prices? Should we let managers at companies be trusted to make long-term decisions, even though it might not help? Or should we displace both groups and replace it with a Ministry of Finance, which is what Japan did for a long time? The way companies made decisions is they hired the brightest people, they put them in the Ministry of Finance, and you tell companies where to grow and what businesses to go into, and they will listen to you. What I'm trying to say is it's easy to take any group and say they're short term. But if you decide to do that, remember, you got to tell me what other group is going to be making decisions that's more long term. So I'm going to present to you with evidence that this conventional wisdom that markets are automatically short term might need some pushback. If you think about short term markets, what should they do? They should reward companies which have the earnings in the now and the here, rather than companies that have earnings way out in the future, right? So a company that is money losing, that's not expected to make money for the next 5 years, 10 years, 15 years in a short-term market should never get a reception. So I'm going to go against the conventional wisdom. I think markets have been far too long-term for the last decade, not too short-term. They rewarded companies with business models that are still being worked out, saying, you know what, we'll give you a $50 billion value. So markets are short-term. then how do you explain the fact that we've had this ecosystem, not just in the US, but across the world, of young money-losing companies that are able to raise money? Second, if markets are short-term, when companies do things that reduce current earnings but create future growth, we should punish them, right? That's what short-term markets do. So I'll give you an example, a company that invests in R&D. The way R&D is accounted for, it reduces your earnings now, but you're saying, you know what, it increases earnings in the future. So I want you to think about, if markets are short-term, then companies that do a lot of R&D, invest in future, should be punished relative to companies that don't. That's an empirical question, right? It's not a theoretical question. It's not an abstraction. And in particular, when a company reports increases in investment like R&D, you should expect to see the stock price drop, because you're basically trading off current earnings for future growth. This is a kind of it's a very simplistic graph looking at stock price reactions to investment announcements, joint ventures, R&D, product strategies, capital expenditures, all announcements. So the red column basically captures what happens the month after the announcement. The blue is what happens in the day. For everything except strategic announcements, and I completely understand why the market is very skeptical of strategic announcements, because you're already telling me nothing, right? Notice that the market reaction is positive. Again, this is not evidence that markets are long-term, but it's basically evidence that maybe this is a much messier question than we're willing to acknowledge. The notion that managers are some kind of, Dalai Lamas who think about the future, who basically don't think, that's absurd. I would argue that managers are far more likely to be short-term in their decision-making because they collect their bonuses, they've got options outstanding, they've got considerations that are short-term. So assume that managers would somehow be more long-term than markets. I think it's just faith. Which leads some people to, hey, let's pick a group of smart people to make decisions for all companies. Now we're going to talk about what happens when a group of smart people make decisions. They might make good decisions and they might make bad decisions. Why? Because you're human beings. You sometimes misjudge. And here's the problem when you have an expert group making decisions. I don't care how smart they are. When experts make mistakes, they don't like to admit them because that would take away their expertise. So there's a tendency for experts, when they make mistakes, to actually double down and triple down and quadruple down. And you can see this all the way from the Vietnam War. After all, JFK got some of the smartest people in as his advisors, and look where that got us. To the Ministry of Finance in Japan, which in the 1980s led companies off a cliff for all the right reasons. But what you think about the objective in corporate finance is going to be very directly driven by what you think about markets. How much do you trust them? Now, of course, every time you have a crisis, people say, I told you so. Markets can't be trusted. So in 2008, you have a market crisis, right? And you're too young to remember, but markets collapse, stock prices go down. So people, I told you so. We need to regulate companies more. We need, and guess which group led us off the cliff in 2008? The most regulated group of all companies, right? It's banks, which had all these requirements on, fair market value, basically a balance sheets that reflect what the company's actually worth today. So if the answer to crises is we're going to create more regulations, crises are essentially parts of markets are going to happen, and markets, the one good thing you can say about them is when they make a mistake, they will correct the mistake. They don't wait for 5 years like experts saying maybe something good will happen. So when you think about that linkage between markets and managers, something to think about is what you think about markets, whether they're short-term or long-term. I'm not going to, as I said, drive you into a conclusion. But I want you to step back and be a little more dispassionate and not accept the emotional argument of market short-term, managers long-term. Let's let managers go and do their thing. And let's not kind of constrain them by saying, why is the stock price down 35%? Any questions about markets, managers? Which brings me to social costs.
Now, we're going to talk a lot more about social costs in the next class, but let's be real. When a company makes decisions, no. And if you think about it, in theory, we assume there are no social costs. In practice, there are social costs, there are social benefits. And this has become the fulcrum of discussion in the last few years, is how do you bring in social costs and social benefits into decision making? To understand why it's so difficult to bring social costs and social benefits into decisions, let's start by accepting a reality, which is, I mean, many people assume that bad companies create social costs and good companies don't. It's not true, right? You could be creating costs that you don't even know are costs until 5, 10, 15, 20 years after. What if we find 10 years from now that smartphones ruin our brain cells? You can go and sue Apple and say, you terrible company, you were trying to make us all stupid. And maybe that's a master plan here. But I don't think Apple's making phones saying, let's make people stupid. The reality is sometimes social costs show up after the decision is made. Second, social costs are in the eyes of the beholder, right? So what you value in society is going to be something you factor in. So if you're sitting around a table, you have 10 people around a table, you're trying to decide on a project, and they say, let's bring in social costs. And I go around the table, each person might be weighing something very different. For some people, it might be the environment, climate change. For others, it might be privacy. For still others, it might be poverty. So social costs are not something we can get consensus on because each of us has our own vision of good and bad. And this is something I'm going to come back and talk about in the context of ESG, is what defines good is a function of where you grew up, what religion you're in, what your family taught you, where it is a product of your experiences and it's yours to hold on to. But if I went around this room and said, define what a good company does or what a good person does, I'll wager I'll get 100 different definitions. And finally, remember, you're still running a business. You got to take projects, you got to make financing. And if you bring social costs and benefits into this process, make the center, I guarantee you there will be decision paralysis. Because you go on the one hand, the other hand, there's no way of quantifying different viewpoints. So I'm not going to be unrealistic and say there are no social costs and social benefits. But I'm also going to argue that making it the center of your analysis is a recipe for essentially not making decisions at all. So when we start on Wednesday, we're going to kind of address this. And in the context, we're going to talk about ESG and sustainability and the other solutions that people have offered to bring in social costs. Yes. Everybody's leaving, so come on down and talk to me.
Sorry, do you think the acquisition of Disney Fox Studios was a good deal for shareholders?
I think it was a terrible deal.
I'm sorry?
I think it was a terrible deal. It was real thought through, and I don't think it was necessary because none of the reasons they gave for buying Fox required them to buy Fox. You want to control Hulu, buy Hulu, right? Why go buy a $71 billion company which has overlap with your own company and then have to deal with the consequences? I think Disney badly miscalculated.
Was Steve Jobs already dead? I don't remember.
Yeah. But I don't think he would have. If he'd been on the board, I don't think he would have. But by the time you get to 2017, Bob Iger was emperor in the imperial. We'll talk about how the longer you stay on, the more it becomes your company, your decision. The board doesn't push back. I think they should have pushed back. And in hindsight, Bob Iger probably wishes that he hadn't bought Fox because it brought in all these headaches with very few benefits. Now, I can't think of a single thing where I look at it and say that company's better off. Maybe some of the Avengers characters that you brought in, $71 billion to be able to have Spider-Man in your Avengers movies sounds like a little bit of an overview. So I think it was way too much money for way too little in benefits.
And speaking of the bidding war topic, like how overpriced would that have been?
I'm sorry?
How overpriced would that have been?
It wasn't massively, probably $15 billion overpricing, but more than the pricing, it was $15 billion.
But I think more than the pricing, what the effect it had on Disney's, within Disney, the morale of employees, right? Which is the day after the acquisition, people start worrying about their jobs in every part, like especially the sports part of Disney, because you're bringing in this fairly significant Fox Sports regional TV into. How does that work with ESPN? So people started thinking about losing their jobs, the cultural consequences for Disney within the company. It's still being felt.
Thank you. Thank you very much.
Hi.
Just had a quick question. I was trying to register for Capsule IQ.
Yeah.
I didn't get the what. I suppose
Talk
send
to
an
IT,
email.
right?
Do I
So
send an email to
basically-
IT directly?
No,
Capsule
send to
IQ IT or
So
send-
do you have a Stern email address?
Yes.
Okay, it should work then. So if
Yeah,
it
I
doesn't work,
tried.
then I don't know why it's not.
IT.
To check with IT.
Stern IT.
No, yeah,
Thank you.
you're welcome. Hi. Yeah.
But, the value of the company that issues bonds will be any different than the company that issues stock.
Okay, issues what? Why they,
Bonds.
but why are they mutually exclusive? Most companies that issue bonds are publicly traded companies, right? So it's almost very, very seldom you see a company issue bonds. It's not publicly traded, publicly traded. It has shares as well. So it's not an either or. And most of the time, you're issuing bonds because you have shares that are publicly traded. So
Yeah, but is it gonna be any difference than this?
issuing bonds is like borrowing money, just borrowing money from the bond market into the banks.
Okay. And, the credit rating of the bonds is actually pretty good. So I was thinking about, could I use the risk-free rate of the bonds from the company as the
Risk-free rate has nothing to do with the company, right? It's got to do with the currency, do the analysis.
No,
So so if you're doing an analysis in dollars, it would be the T bond. If you're doing it in euros, it would be the German euro bond. So basically, it's got nothing to do with the company.
okay, that makes sense. Thank you.
You're welcome.
Hello, Professor. So you mentioned that the markets, they keep the long-term perspective in mind more than the short-term. But
I didn't say that. I said that that's the conventional wisdom, that markets are short-term. I didn't say they were short-term, right? In fact, I just said that the evidence is,
that they're more long-term.
that, I'm saying that the evidence is, there's a lot of circumstantial evidence. They're far more long-term than markets give them credit to.
Right.
And of course, there
Exactly.
will always be cases where they do the stupid short-term thing. But on balance, if you